Welcome to the LeitnerLeitner VAT Update, your quarterly briefing on indirect tax developments across Central and Eastern Europe, prepared by our CEE VAT experts. In the next few minutes, we'll walk through the quarter's key changes, country by country, leading with what matters most in each. Let's get into it.
In Austria, the Supreme Administrative Court sharpened the chain transaction rules. The triangulation simplification does not apply where the final customer collects the goods directly from the first supplier under an ex-works arrangement. The transport is then allocated to the second supply, so the simplification fails. Other Austrian rulings cover abuse of law in property leasing, acquisition VAT for flat-rate farmers using their VAT identification number, and a denied export exemption for under-invoiced goods.
Bulgaria's news is still at draft stage, and the headline is a zero rate on food. A draft bill would apply 0% VAT to the basic consumer basket, so bread, milk, dairy, basic meats, and poultry. If adopted, it enters into force with the 2026 State Budget Act. A second bill, also awaiting a vote, would lift the mandatory registration threshold for micro and small businesses to €85,000 from January 2027.
Croatia has extended its 5% rate on energy. It covers natural gas, heating from thermal stations, and firewood, pellets, briquettes, and wood chips, and runs until the end of March 2027. The government can now also float the VAT rate on excise energy products, though it may not go below 15%. Other Croatian updates cover fiscalisation of foreign currency e-invoices, cash-on-delivery transactions between businesses, and the special scheme for travel agents.
The Czech Tax Authority has clarified the timing of VAT deductions. Responding to a general court judgment still under review by the Court of Justice, it confirmed that input VAT may only be deducted once the taxpayer holds a valid invoice, even where the taxable event fell earlier. Other Czech news covers the second generation of electronic sales reporting, changes proposed for 2027 to rates, bad debts, and the car deduction cap, recipient liability for unpaid VAT, and advance payments.
Germany's Federal Ministry of Finance has changed its approach to non-economic use. An increase in non-economic use is no longer treated as a deemed supply. It triggers an adjustment of the input VAT deduction instead. That applies to VAT groups and all open cases, with the previous treatment available until the end of 2026. The Federal Fiscal Court also held that a domestic liaison office is not the recipient of services ordered for a foreign parent.
In Hungary, the Tax and Customs Administration, NAV, has clarified the 5% rate for residential property. Storage rooms, and in certain cases parking spaces, sold with a qualifying home can also benefit from the reduced rate. That closes a gap open since 2016. Hungary has also published the machine-to-machine interface for electronic VAT reporting, expected from January 2027, and the new government plans lower rates on healthy foods and firewood, plus an exemption for prescription medicines.
Poland's e-invoicing mandate is now in full swing. Since April, the obligation to issue and receive invoices through the national system, known as KSEF, applies to all entrepreneurs and local government units. Only the smallest taxpayers remain under transitional rules. Other Polish news covers a temporary 8% rate on motor fuels, wider Labour Inspectorate powers to reclassify contracting arrangements, vetoed amendments to the disclosure and penal rules, and a deduction judgment now before the Court of Justice.
Serbia amended its VAT Act, and the practical change concerns returned goods. Since April, a return no longer counts as a fresh supply. It reduces the tax base of the original supply instead, whatever the reason for the return. The VAT rulebook changed as well, with new rules on advance invoicing, on the deadlines for adjusting the tax base, and on internal invoices issued through the electronic invoicing system known as SEF.
Slovenia's planned VAT changes are on hold. The Act on Intervention Measures has been formally suspended because proceedings are pending before the Constitutional Court. That freezes a 5% rate for certain essential foods, gluten-free products, fertilizers and seeds. It also freezes a temporary cut on energy from 22% to 9.5%. Until the court rules, the existing VAT legislation applies in full, and none of the proposed changes have entered into force.
This audio edition is drawn from our written VAT newsletter. The analysis is the work of our tax specialists, and AI drafted the narration you've just heard. The newsletter carries the full detail, so do read it. And should you need tailor-made guidance for your business, please let us know anytime. LeitnerLeitner, we for you.